Today we will do an in-depth analysis of Max Healthcare Institute Limited as of 1st November 2025. Disclaimer: this video is for education and information only. It does not contain any buy, sell, or hold recommendation, and it does not provide entry-exit levels, targets, or personalized financial advice. I'm not a SEBI-registered advisor or research analyst. The discussion is based on publicly available historical company disclosures and industry sources as of the 1st of November 2025, Asia, Kolkata. Figures mentioned are for learning and may contain errors or omissions. No compensation has been received from any company or intermediary for making this video. Please do your own research and consult a SEBI-registered professional. Let's talk about the company, the stock symbol, and the analysis date. The company is Max Healthcare Institute Limited. Its Indian exchange identifiers are Max Health on the National Stock Exchange and 54322 on the Bombay Stock Exchange. This overview is prepared as of 4 November 2025. It summarizes the business model, historical financial trends for the last 3 fiscal years, plus trailing 12 months where available, the capacity expansion pipeline, risk factors, ownership patterns, and commonly used valuation lenses in the Indian hospital sector. Any references to market data are historical snapshots for education and are not live prices. Let's talk about what the company does. Max Healthcare operates a network of multi-specialty and super-specialty hospitals in India, with a concentration in Delhi NCR and additional presence in cities such as Mumbai, Mohali, Bathinda, Dehradun, Lucknow, and Noida. Core clinical lines include oncology, cardiac sciences, neurosciences, orthopedics and joint replacement, renal sciences and transplants, bariatric and GI surgery, women and child health, intensive care, and emergency services. Beyond inpatient care, Max runs outpatient clinics, daycare procedures, diagnostics, and preventive health programs. Let's talk about their products and services. In hospitals, products are clinical services and care pathways. The company's revenue engines are inpatient admissions and daycare procedures across high-acuity specialties, outpatient services such as consultations and imaging, and 2 adjacencies, Max Lab, diagnostics for external customers, and Max at Home, home healthcare, sample collection, chronic care monitoring, physiotherapy, and nursing. The network targets urban and premium segments, which supports higher average revenue per occupied bed, driven by complexity of procedures and payer mix. Let's talk about the revenue mix. Hospital services form the vast majority of operating revenue, historically in the 92% to 95% range. Max Lab and Max at Home together contribute a single-digit percentage, roughly 4% to 8% depending on quarter and seasonality, but have grown faster than the core on a smaller base. International patient revenue has typically been in the high single digits of the total, around 9% to 10%, and tends to lift ARPOB because of case complexity and self-pay share. The Delhi NCR region remains the largest geographic contributor, with increasing contribution from recently integrated assets in Uttar Pradesh and from Mumbai and Punjab as capacity ramps. Let's talk about stock performance. Post-listing Max Healthcare, listed in August 2020 through a demerger reverse merger route. From early listing reference levels in the low hundreds of rupees per share, long-term shareholders saw multi-year appreciation running into several times their initial value. The path included standard drawdowns typical for equities, for example, a mid-2022 correction during a broad market sell-off, a post-results pause after FY 2023, and a pullback after FY 2025 results when near-term margins reflected new capacity ramp-up. These are historical observations for education only. This video does not provide real-time quotes or trading guidance. Let's talk about the revenue trend in the last 3 years. On a consolidated basis, operating revenue grew from approximately 4,563 crore in FY 23 to about 5,406 crore in FY 2024, and further to roughly 7,028 crore in FY 2025. Year-on-year growth in FY 2025 was around 30%, supported by network expansion, including acquisitions in Lucknow and Noida, and a new unit in Dwarka, Delhi, and by organic volume growth at existing hospitals. Over these 3 fiscal years, there was no annual revenue decline. Earlier pandemic-era softness had already normalized before FY 2023. Let's talk about new products and services and management's mix outlook. The growth strategy has combined brownfield and selective inorganic expansion. Over the last 18 to 24 months, the company added a new hospital in Dwarka, integrated a 500-plus bed hospital in Lucknow, and took over a large hospital in Noida. Brownfield additions are underway at Saket, Delhi, Mohali, Punjab, and Nanavati, Mumbai. A multi-year capex plan of roughly 6,000 crore targets about 1,900 incremental beds by FY 2027. While there is no formal revenue mix guidance for the adjacencies, Max Lab and Max at Home have been scaling from a small base at double-digit to high double-digit rates. Management commentary has emphasized volume-led growth with mid-single-digit ARPOB increases through pricing discipline and richer case mix as new specialties and international flows scale. Let's talk about order book or backlog. Hospitals do not operate with order backlogs like manufacturers. The closest proxy is the capacity expansion slate. By FY 2027, installed beds are planned to cross 7,000, up by about 1,900 versus FY 2024. Near-term milestones include substantial bed additions at Saket, around 400 beds, Mohali, around 450 beds, and Nanavati, around 250 to 270 beds, plus incremental capacity at Lucknow and Noida. These commissioning timelines provide visible volume drivers over the next 12-24 months. Let's talk about why revenue might have dipped, if at all. Across FY 2023, FY 2024, and FY 2025, annual revenue did not dip. Each year set a new high. Temporary volume softness was a pandemic-era phenomenon prior to FY 2023 and was offset at that time by COVID-related services. Let's talk about the EBITDA trend. Operating EBITDA rose from about 2,041 crore in FY 2023 to roughly 1,492 crore in FY 2024 and to approximately 1,849 crore in FY 2025. EBITDA per operational bed remained among the highest in the listed peer set, around 7 million per bed per year on an annualized basis, while naturally diluting in periods when large numbers of new beds were added ahead of full utilization. Let's talk about the EBITDA margin trend, and any dip EBITDA margin expanded through FY 2023 into FY 2024 and then moderated in FY 2025 by roughly 200-250 basis points to the mid-20s%. The moderation reflected expansion phase dynamics, startup losses at newly commissioned units, initially lower margins at acquired hospitals during integration, and higher staffing and operating costs associated with scaling. Management commentary has indicated that excluding new unit drag and one-offs, underlying network margins were closer to the high 20s and are expected to normalize as occupancy increases and synergies are realized. Let's talk about debt to equity and whether debt is high. As of FY 2025, long-term borrowings were around 2,270 crore against total equity near 9,260 crore, implying a debt-to-equity ratio close to 0.25 times. Including short-term items, forward-looking net to EBITDA screened well below 1 time. Management has stated the intent to fund most planned expansion through internal accruals. On these metrics, leverage appears conservative for the company's scale and CapEx program. Let's talk about cash flow conversion and how it compares. Operating cash flow in FY 2025 was above 1,400 crore, broadly around 3/4 to the low 80s% of EBITDA, depending on working capital movements. The business benefits from structurally short receivables and supplier credit on consumables and services, creating a negative cash conversion cycle. Compared with large listed peers, cash flow conversion would generally be considered good, supporting expansion with limited reliance on external borrowing. Let's talk about the one-year stock price trend and any dips. Over the year preceding 31st of October 2025, the stock traded within a broad range and delivered a positive total return on a historical basis. Short-term pullbacks coincided with events such as the FY 2025 results, where profit growth lagged revenue due to expansion phase margin effects, and a small secondary sale by a foreign institutional holder via a block trade. These are educational, historical notes only. No live quotes or trading cues are being provided. Let's talk about promoter share purchases. As per the latest published shareholding pattern for the recent quarter, promoter holding was in the vicinity of 23.7% and stable across recent periods. There were no disclosed open market promoter purchases in the latest filings. Promoter share pledging stood at 0%. Let's talk about valuation lenses and how the company fares. For educational context, investors often look at price to earnings, price to book, and EV/EBITDA based on trailing or forward consolidated numbers. Historically, MAXHEALTH has traded at a premium to many peers on PE and PB and at elevated EV/EBITDA on trailing cash earnings, reflecting expectations for sustained growth, high RPOB, and margin leadership. This section is descriptive only. It does not opine on fair value and does not suggest any action. Let's talk about variables and risks. Industry cyclicality is generally low because medical demand is relatively non-cyclical. Seasonality is modest. Elective procedures can soften during monsoons and strengthen in winter and at fiscal year end. Regulatory and policy risk is medium. Changes to device price caps, package rates, or scheme reimbursements can affect realizations. For example, changes to CGHS tariffs can alter payouts. Input cost risk is medium given wage inflation for doctors and nurses and imported equipment costs. Customer concentration risk is low because revenue is spread across thousands of patients and multiple payer channels. CapEx intensity and execution risk is high due to the multi-year bed addition program. Delays, cost overruns, or slower than expected ramp-up can affect returns. Working capital risk is low owing to negative cash conversion cycles typical of private hospitals. FX risk is low, revenues are rupee denominated, and foreign currency liabilities are limited. Competitive risk is medium because major chains compete in overlapping catchments for talent and complex cases. Technology disruption risk is low near term, as digital and AI tools are enablers rather than substitutes, and the company participates in teleconsults, diagnostics, and digital funnels. Contingent liability risk is not highlighted as material versus net worth in recent disclosures. Let's talk about whether the business is cyclical or seasonal. The business is not cyclical in the traditional sense. It is mildly seasonal. Elective volumes can dip in the monsoon quarter and typically recover in winter and toward the fiscal close. Such shifts influence quarterly mix by a few percentage points and do not change the structural demand outlook. Let's talk about promoter share pledging. Promoter pledge is reported at 0%, which indicates no encumbrance of promoter equity as collateral. Let's talk about the latest news in the last 1 to 2 months. In the September-October 2025 window, the company reported a quarter with year-on-year revenue growth in the low 20% and operating margins in the mid to high 20s on an adjusted basis, while integration-related items affected reported margins. A foreign institutional shareholder executed a small block sale in late September as part of routine portfolio activity. Sectorally, government revisions to certain scheme tariffs were announced. These are part of the evolving regulatory landscape and can influence realizations where applicable. Let's talk about analyst ratings and when they were given. During late September and October 2025, public summaries from brokerage research showed a positive skew in ratings, with a clustered fair value view in the low 300s on a 12-month horizon and a range of opinions around that median. This mention is for context only and does not endorse any rating or target. Let's talk about which mutual funds and FIIs hold the company WES. As per the latest published shareholding pattern for the recent quarter, foreign institutional investors collectively held slightly above half of the equity, while domestic institutional investors, of which mutual funds form the largest subgroup, held around 1/5. Mutual fund ownership increased modestly over recent quarters, reflecting steady accumulation rather than a single large transaction. A notable foreign holder trimmed a small fraction of its stake via a block trade in late September. These are historical disclosures used for education. Let's talk about promoter share contribution. Promoter share contribution was around the mid-20s% in the latest filing period and has been stable across recent quarters. Let's talk about regulation and government oversight. Private hospitals operate under a multi-layered framework: clinical establishment norms, accreditation standards, medical device pricing policies, and scheme-linked package rates. The sector also participates in public health initiatives. Changes in reimbursement and pricing frameworks can affect realizations and are a core external variable that investors typically monitor through official circulars and company disclosures. Let's talk about growth outlook from the last 2 investor calls. Management commentary over the last 2 calls emphasized capacity-led growth with double-digit volume increases, mid-single-digit RPOB improvement, and a margin profile that trends back toward the high 20s% as new units stabilize. Occupancy has been cited in the high 70s to low 80s% in recent updates. The commissioning calendar, Saket, Mohali, Nanavati, and incremental beds in Lucknow and Noida, anchors near-term visibility. Let's talk about management guidance for the next 12 to 24 months. The company does not publish formal per-share guidance. Qualitatively, commentary implies revenue growth in the high teens to low 20s%, with margins normalizing once integration costs abate. Free cash generation after maintenance CapEx is expected to remain positive, with the multi-year CapEx plan funded primarily through internal accruals. These are directional statements from public discussions and may change with operating conditions. Let's talk about the future order book. In hospital terms, the order book is the build-out slate. By FY 2027, management plans to add about 1,900 beds compared with FY 2024, taking installed capacity above 7,000 beds. This slate provides multi-year visibility to volumes and operating leverage, subject to timely commissioning and ramp-up. Let's talk about how investors typically evaluate such businesses. Educational. This is not advice. In general, investors studying the hospital sector track a few operating levers over time. Occupancy staying around the mid to high 70s% as capacity scales, RPOB trending up in line with case mix and pricing discipline, EBITDA margins holding in the mid to high 20s% as startup losses fade, and progress against the announced commissioning calendar. For context, they also compare valuation multiples such as PE, PB, and EV/EBITDA across peers to understand relative pricing, while recognizing that premium multiples often embed expectations about growth and returns on capital. None of these observations imply any recommendation. Subscribe for more company news daily.